Hims finally looking like it might have bottomed out in the low 40s. Amazon up close to $10 a share today, and Lululemon getting pummeled after the close. Stick around. I'm going to go over all three of these, potentially talk about some other things. Should be a great video today. Hello, my name is Adam Kahn, and this is Investing with Adam K. Hope everybody's doing well. Another good day in the market, which is really nice to see. I think both NASDAQ and Dow closed at all-time highs, and I think that the S&P was pushing it. So really nice to see. We have a big number coming out tomorrow. We'll see how the report comes out, how the markets react to it. I think today's action kind of shows that it probably won't impact too much. Everybody's looking towards the Fed rate cuts coming September, and I'm guessing the jobs number tomorrow isn't anything that anybody sees having a huge impact unless something really wacky comes out, which is why I think we had a strong rally today. So Hims to me looks like it finally bottomed out in terms of what was going on with Novo Nordisk and their compounding and everything else. I actually think Hims is a really good stock to own, which is why I picked it to have in my trading account. It was a bit of a relief the past couple days watching it rally a bit. It still hasn't gotten back into the range I'd like to see it get to, but I do feel like it kind of bottomed out in a good, proper way. I didn't look at the charts. I just go off a feel more than anything else. It kept testing that $40 area. And then today, I think it closed above $48 a share, which is really nice to see. I'm not expecting any huge rebound. I'm actually hoping that it just takes its time and slowly so that it builds a nice base. The other thing is it did this previously. It shot up to approximately $70 a share. Then it fell down to about $35 a share before it went back up to over $70 a share, having the earnings that wasn't as great as they expected, as well as the Novo Nordisk news, pushing it back down to about, as I said, down to around 40, where it tested it a few times, and feels like the selling pressure kind of waned and finally had a little room to start moving up the past couple days. Now, this is not financial advice, as always. This is not a recommendation. Please don't listen to me. You need to make your own financial decisions and do your own research. Shouldn't listen to me or anybody on YouTube, especially me. I think I'm a huge idiot. I've just been really lucky over the time. I'm sharing what I do, and hopefully you find it entertaining and maybe get some ideas for, what to do for summer vacations and stuff like that. I just like to talk markets, so I discuss it here, but really just use it for entertainment. That being said, it really was nice to see. The Patient Investor also did a really good video on it. I like his content. I started watching him recently, and he talked about like how it's only 3 times sales, which is extremely low for a company growing as quickly as Hims. And to be fair, it's kind of how I feel. And what I like about the company is while it is not a subscription model, it sort of is. It's not like you sign up and you pay a monthly fee. But if you start using them to have your prescriptions delivered to your house, I'm guessing it's a super simple process. It gets easy to do, similar to like starting to use Amazon or anything else. And it's probably something that once you begin, you stick with it for a long time. I also think that the big boys, like similar to what happened with Netflix, I don't understand why Amazon or some of these others don't take a real push to try to really tackle these industries and beat them to the punch. But I think they get too ingrained in their main businesses to worry about the ancillary stuff. And I think in some ways they end up missing really good opportunities. And I think Hims is going to be another one of those. That by the time they become the dominating leader, is when the others are going to start looking into it. And by then, it's too late. They already have their customer base. They have people consistently getting their medicine from there. And it'll be hard at that point for somebody to come in and start stealing that business from them. I feel like that's kind of what happened with Netflix too, because I never understood why Amazon didn't do a better job with Prime, or that Google didn't mix in movies and original content and just stuck with, for YouTube, the stuff like what I do, which I'm thrilled about. Like, I got no issue with it. Or that Apple TV didn't really start pushing some of that either, because they all just are these like separate businesses that don't do much. I think Disney is kind of trying to, but it's a little too Disney. Like they need to branch out a bit and mix in some other stuff as well as maybe have shows and whatever else similar to Netflix. Anyway, that's a long way to go for there. Also, it seems like today was like Amazon's turn. Yesterday was Google and Apple. And to be fair, Google had a nice follow through today, and Apple even seemed to be closing near its highs, which I'm thrilled to see. I had a long conversation with my brother today about, trying to beat the S&P. Now, me personally, which is why I say don't follow my advice, I don't think I'm really trying to beat the S&P. But if I were trying to come up with a portfolio that was trying to beat the S&P, I think I would have the Mag 6. I'd exclude Tesla just because me personally, I think that Tesla is a little overvalued. So it's very hard for me to invest in it and have money. Like it just is. But if I took Amazon, Apple, Google, Meta, Microsoft, and Nvidia, I think you're going to outperform the S&P by owning those companies. I think there's potential that you would miss out on a Palantir that might take off and do incredibly well. That's not advice to buy Palantir. I think it's beyond frothy. I just feel like it's kind of the popular guy right now that's getting the news, and generally the popular stock tends to continue for a while. Not advice because I think it's really expensive, so I don't want to hear heard the wrong way. But I think if you stick with the Mag 6, while you might miss out on the guy that just goes straight up and does incredibly well, I feel like it will outperform and you will do better than the S&P by focusing on companies that are continuing to grow at a faster pace than the others. I also think that they're in the position that they're going to continue to grow like that for the next few years. So why would you even pick other stocks? At least for me, it is to be able to have some security that if there's a reversal in a downturn, that I'm not too stuck into just a few stocks, and I have some supporting things around it that really I don't expect them to perform as well. For example, one of the ones I have in my set it and forget it account is Disney and also Pfizer. I don't really picture Pfizer keeping up with the S&P 500 or the broader market. But at the same time, if the market reverses and starts to go lower, I see it as a bit of a hedge that'll hold up just fine. So I want to have that balancing out that isn't so aggressive to simply just be trying to beat the S&P. I don't know. Tell me, like, what's your goal in your accounts? Do you guys try to beat the S&P? Do you not worry about it? Or do you just generally try to pick stocks that you think are going higher? I do think the real way to do it are things like United Health, banging my hands on the table, that if you stick with the ones that are super undervalued and have really negative news at the current time and stick it out because the news will fade, that you'll outperform that way as well. Like I really do think that United Health right now is the best bargain in the market. It doesn't necessarily mean over the next 6 months or a year or even possibly 2 years that it couldn't have more downward pressure and fall back down. I think it legitimately could. But I also think if you go out 5 years when that news is faded and nobody is talking about the things that are going on today, that pressure that gets pushed on it will have been gone and it allows it to float back up, if that kind of makes sense. It's kind of what my point was with Boeing. You're not going to have planes crashing forever. Like you will, but you're not going to have it in the news the way it was. You're not going to have the what was it? Not the riggets or something, but coming off of door handles and just the media that they were getting of all that negative stuff. Eventually that stuff fades. And while it will stay in people's mind for 6 months or a year, eventually they kind of forget. By the time they forget, everybody who wanted to sell has sold. Anybody who's buying it to trade it has gotten out as well. And what ends up happening is you just kind of run out of sellers because they've gotten exhausted. So it's not necessarily a bunch of buyers coming in, driving it up, and great news or anything else. It's that you've taken all of the sellers out of the market. So the only way that the stock has to go at that point is higher. It's how I feel about United Health. There was so much negative news, so much pushing down on it, so much selling pressure. Every day when you turned on the news, whether it was about Mangione or whatever his name, and the CEO, and then to the earnings being a little bit rough, and people wanting to hate healthcare, and then that Trump is going to be hard on healthcare with RFK and the things that they're going to do to make it more fair, which might be great, like legitimately. Eventually, that news is not going to be news anymore. The stations are going to move on to something else. They're going to find other things to discuss, and when they do, they'll have taken all of the selling pressure out. Now, that doesn't mean just go straight up, but what it does mean is they'll become like everybody's exhausted. Anybody who wanted to get out got out. So the market will have its ups and downs, but there will be more buyers than the sellers because the sellers are done. That's my theory on why you wait for like really bad news on companies. I don't think you have to do the research or the valuation that some of these guys, while I like to do it, and I also find those analysis really interesting, I think that the market is pretty well priced every moment of every day, meaning that the big guys and the analytics and their algorithms and the computer programs that they use to make the determinations that they do are really good about pricing where stocks should be and figuring out future earnings and trying to rationalize like where it should be today based on future earnings and everything else. So if you don't want to sit down and you're not that guy that loves playing with numbers, just pick great companies that you think are going to stay in business and do really good sales, and you'll do just fine. And if you don't even want to do that, there are ETFs out there that work perfectly well. Like I said, there's no reason not to put 100% of your money in VOO. I mean, then you just own the S&P 500 and you don't even have to think about it. You want to mix in QQQM or an international one or SCHB if you want some dividends? Great, that's just fine. I do think there's a point that you get overly spread out, and maybe that's what you want, but really it should be whatever you guys think. Either way, if you want to beat the market, I think if you just stuck with Magnificent Six and didn't worry about all the noise of all these other things and everything else, my guess is you'd have great returns and you would outperform the S&P 500. And the other one I mentioned, Lululemon is getting pummeled. A stock I have a little bit in, and I'm not thrilled to see it getting pummeled, but it is. The last I looked, now I don't know, it might be changing as I'm doing the video. They were down like 12%. They closed at $206 a share, I think, and they were trading below 180 by the time I started doing the video. I didn't look again, so it could have changed by now. But generally, when things are getting beat up that badly, it's not like they just turn around and go the other way. While I hope that it does, I'm guessing that it's just getting beat up. Either way, they missed on revenues by a little bit. They beat on earnings, but their forward guidance wasn't as great as the market wanted. But it's kind of my point. In time, if you believe in Lululemon, that'll fade. Eventually, they'll do okay. If you think they're going to continue to do well and be the leader in exercise clothing or yoga clothing and whatever else they expand to, their earnings are decent and their price to earnings ratio is pretty reasonable as well. Now, if they continue to slow down and they don't grow at the pace the market wants, their PE could get lower and lower, even if their earnings continue to do okay, and they could struggle for a while. I guess me personally, I always see the stores busy. They get really good margins. If I heard correctly, it's like 55% margins, which is phenomenal. So when I see those stores jam packed and their margins are really good, I don't worry too much that they're going out of business or that it's going to get worse and worse and worse. Obviously, it can. The market is, I still think they price accurately. So if it's down 12%, I think that's probably appropriate for what they're doing today. I just kind of, along the lines of what I'm talking about and time things change, assume that in 2 or 3 years, they're probably still doing just fine. And maybe they're not rocketing higher. Maybe nothing exciting is going on in Lululemon. Maybe they've hit this phase where they just aren't growing it the same way. but I think they've established themselves at this point as a pretty big company that does a good business, that maybe they're able to get some management in that comes up with some ideas that create an ability to turn it around and start growing again. And if not, maybe they're just a stagnant company that just limps along for a while. As long as it's not too big a percentage of somebody's portfolio, oh well, they still have a good name. You still should hopefully have some stocks that are performing well, and it'll all balance itself out. Now, if you've been listening to some of the people who talk about their wheel strategies and how to use options to make 100% return over a year, considering that Lululemon fell, that was probably a bad pick. Like when I've listened to their videos, all you have to do is pick stocks that are going higher. And if I were to guess, the faster they're going higher, even better. So since Lululemon went lower, that would have probably been a bad one to pick to use in those strategies, and you know doesn't work quite as well. Obviously I'm kind of joking, but I've watched a bunch of those videos and I keep watching them, and it kind of cracks me up when I watch all of them as to how they just say, all you have to do is pick stocks that are going higher, and then you can use these strategies to do really well. I don't know why you would even get mixed up in trading options if you were so perfect that you would just buy stocks that are going higher. To be quite honest, part of the reason to sell covered calls is to make back a little bit on the companies that aren't going higher, because I don't know anybody who can just every stock they pick, they go higher. The other one that was the most interesting to me that I've talked about a few times, and I'm starting to look at some other slow movers, was Conagra, because it's really incredible to me how I can take a company like Conagra, look at some options, and get a 10-cent call that I can sell, or a 15-cent, and feel like now I'm pushing almost 20% returns in Conagra between the calls that I'm selling along with the 7% dividend that it's yielding. It's really interesting. So for those of you who haven't looked at options before, if nothing else, it's worth pulling it up on your screen, kind of pricing them out, and having some general idea of what you would get if you sold a call maybe a month out on a stock that you own. Now, again, that's not investment advice. Don't follow me. But I think it's pretty cool to take a boring stock. Like, I don't expect to get 20% returns on Conagra. And then I look at the options and see an avenue to get there, and I'm really amazed. I mean, I don't picture them going much of anywhere. Even if you own them the past few years while they've just dropped in price, I would guess if you were able to sell the covered calls all the way down, you probably didn't lose a whole lot of money. I even started looking at it in Verizon because I like the dividend in Verizon. They pay, I don't know, 6.5% or something on a dividend. So I started selling just one put at a time to start a position in Verizon. The 20 cents on a weekly option, while it sounds like nothing, because after the 50-cent commission, if it was literally 20 cents, I think it was like 22, the one that I sold originally, it's only $19. It's not a lot of money. But when I multiply the 19 out by 50 weeks, it adds up, and the stock is only trading $44 a share. So if you get $20, 50 weeks out of the year, that's $1,000. You guys can tell me if my math is wrong. I just did it in my head. Well, $1,000 on a 40 some odd dollar stock is almost 25% return. I don't know where you're getting that in terms of that type of trade. And if I get stuck with 100 shares of Verizon, great. It pays a 6.5% yield. I'm perfectly happy to buy it. And maybe I sell a put a little bit lower and collect another 20 cents. The thing to be careful of is your position sizing. You have to be comfortable with how many you're selling so that you don't end up having, I'll make a number up, put 1,000 shares of Verizon on. If you're uncomfortable with 1,000 shares of Verizon and you don't want a $45,000 investment. So that's the thing to be careful of when doing these types of scenarios, because as you can see, if you look at the history of Conagra, a stock can trend in a direction for a very long time. So you could end up just getting assigned and getting assigned and getting assigned and getting stressed about that. Now, if you get assigned by selling the put and you're able to sell a call for another 20 cents and continue to do that on the way down, I think that's where the wheel strategy protects you. If you're only doing it like I am in the trading account with high volatility stocks, you may find that the ups and downs are bigger than you expect in either direction. You might have a rough time with the down moves, and you may not be able to keep up the same way as the stock continues lower. I mean, like HIMS, for example, fell from 70 to 40 in a very short amount of time. It would have been really difficult to be able to use weekly options to be selling lower puts, collecting some money, even if you get assigned to then reverse and sell some calls. I went a little further out. I did monthly. It seems to be working out okay, and I'm really focusing on the options that I'm selling. But I think it would be difficult with some of these higher volatility stocks to be able to do that, despite that those are the ones that the people are using in their examples. It's really interesting that they just happen to have the ones that are going straight up that are doing incredibly well and don't address ones that are struggling, which is why I wanted to address the one that's struggling. I think people get a lot of bad information, and I would rather share that things don't always go perfectly. They'll work themselves out and the market will average what it averages, but one or two or three, like, you have to be careful. You don't want to over trade anything. You want to make sure you know your emotions and everything else. And at least for me, because I know that as a kid the ups and downs, like, they didn't impact me, but as I've gotten older they kind of do. That if I focus on a Verizon or a Conagra and start pushing the options a little bit, where I can make it, in my mind, exciting. Because if I'm getting 20% plus returns, that's exciting to me. I know it doesn't sound like a lot, and who gets excited over that stuff? Well, boring old me, I get excited about that stuff. And then I don't get overly uptight about the stock and its movements, because on average, while they could, they don't have big surprising moves that catch me off guard. Of course, they might be down 50 cents or $1 in a day, maybe even $2, and I'll get caught off guard with Conagra. But for the most part, most days it moves 10 or 20 cents. It's not anything that's that big a deal, and it doesn't impact my nervousness or anything else. I don't know. What do you guys think? Do you like the high volatility ones? Do you like the boring stuff? Have you done the math to see what type of returns you can get on the boring stuff? I know one of the people has been doing it in Grab, which I thought was pretty smart, because by having a really low stock price, I'm guessing the options have a decent volatility, and similar to what I'm talking about with Conagra, even if they're only getting 10 cents on the option, that 10 cents is significant percentage wise, considering the stock only trades $5. So there are lots of interesting ones out there that I hadn't even thought about, that I'm beginning to pay attention to more. I also think if you just stick with the Magnificent Six, that there's a good chance you outperform the S&P 500, but I don't know that that's everybody's goal. So if you can't share what your goal is your goal to outperform? Is your goal to do worse? Is your goal just dividend income? Or is your goal to try to accumulate as much money as fast as possible in order to retire? I love the comment section. I love getting to know you guys a bit. It's super cool. I am not really like, I'd be thrilled if the channel grows. I don't want to lie about it, but my real goal is you guys give me an outlet to be able to speak about the things I like to. And on top of that, sometimes you actually help me on my trades. By talking through the HIMS trade, I've been a lot more patient. I know myself well enough. I might have gotten nervous and sold when it got down to $40 a share. Now, maybe I'll regret that I didn't, because going forward, it could go right back down and end up in the 30s again. But since that was what my plan was, and discussing it on the video, it's helped me stick to the plan, which is really what I'm hoping to do. Because when I look at what you get from selling the options in HIMS, I think I'll make up any down moves by being able to sell additional options. Anyway, have a great day. Tomorrow's Friday. I'm actually going to cook some beef ribs again. I'm really excited about it. The first time they came out incredibly well. So I got a buddy coming over. We're going to drink some Muay Thai, if any of you know what that is. and I'm gonna cook the beef ribs. And if they come out that good again, I'm guessing I'm gonna have to make it for some other friends as well. I'm worried I put my foot in my mouth and told them that it came out really good, and I'm gonna cook it the next time, and it's gonna suck ass, and I'll be really disappointed. Either way, I hope your day is going well. I hope you have some exciting plans for the weekend. Um, yeah, that's about it. Do me a favor if you haven't already, give me a thumbs up, hit that subscribe button if you haven't, make some comments in the comment section. Have a great afternoon.